Good afternoon. Welcome to the weekly livestock market update. I'm Brownfield anchor reporter Megan Grebner with this as always to talk all things markets. University of Missouri, Scott Brown. Good afternoon, Scott.
Happy Friday, Megan.
Happy Friday to you. Happy post Halloween. Did you have any tricks or treats?
So we had neither. So we actually did very well. And it was just another day in the Brown household.
I spent mine in Indianapolis with about 60,000 kids, 70,000 kids dressed up as FFA members or as FFA members. I'll be back in Indianapolis tomorrow to wrap up our coverage of the National FFA Convention as officers. The new officer team will be installed. So it's been really fun to watch some of that from afar and up close and in person this week.
Those blue jackets bring back a lot of memories.
I'm rocking a little gold today just to celebrate them as well.
Oh, I thought it was Go Mizzou Tigers beat Georgia.
Oh, no, never. We're not an SEC household. Sorry about that. Big 10 all the way. Boiler up. All right. We're going to talk a little restaurant performance index. We're going to talk some jobs, preview the week ahead in reports. But to kick things off, let's recap what happened this week in the markets.
Yeah, Megan, on the cattle side this week, a little bit of recovery in fed cattle prices. We're up 65 cents this week. You know, we really didn't get a lot of tests on those feeder cattle markets this week, just pretty limited trade around the country. On the future side, December live cattle futures contract was up $1.85, and the January feeder contract was up $4.25. We lost $1.80 on the choice box beef price, despite what was a pretty strong run in higher rib prices this week, up $17.50. On the hog side, cash barrels and gilts down another 90 cents this week, not what we wanted to see. December lean hog futures contract was up $1.45, and the pork cutout value was basically unchanged on the week as higher hams were offset by what were lower belly prices this week.
I want to talk a little bit about cash hogs, but I'm going to wait until we get into this livestock slaughter or into the weekly slaughter numbers, because I think that that conversation probably fits a little bit better there. Let's run down what happened this week in terms of slaughter for both cattle and hogs.
Yeah, so USDA tells us for the week ending November 4th, a run of 632,000 head of cattle this week. That's down 4,000 head from what we ran last week and down 36,000 head from what we ran a year ago. On the hog side, big run of 2.677 million head of hogs this week, up 63,000 from last week and up 102,000 from where we were a year ago.
When we're talking about those numbers year over year, how are cattle and hog slaughter percentages stacking up?
Yeah, so when you look at cattle slaughter, we're down 4.6% year to date. And on the hog side, up 1.5% year to date.
All right. So obviously a very large run of hogs this week in terms of slaughter numbers. My assumption is there's not a lot of competitions and nobody's having to work real hard in procurement efforts. How much does that impact what happens on the cash hog side of things and where prices end up?
Yeah, I think you probably hit the nail on the head. Between now and the end of the year, I'm not sure we're going to see a lot of price strength in cash hogs, as I think we're going to have plenty of supplies to slaughter on a weekly basis. So I think we're going to struggle here for a little bit longer. And it's unfortunate for an industry that's been really challenged, and maybe the most challenged ever financially, at least for a long time. And some will suggest it outweighs the tough times of 1998, 1999 this time through. So I don't like having that kind of forecast, but it sure looks like we're headed for not a lot of recovery, and perhaps just given productivity gains, we're going to see production still higher in 2024. So I can be a little pessimistic longer term as well.
And that's not something that can easily be fixed, especially with how productive and how efficient we are in that cycle, right?
Yeah. So we have a hard time losing sows, but we've lost 1%. That's what we got out of the last report. Yet, I'm sure everybody sent their most productive sows to slaughter. I'm kidding here. So we're losing the least productive animals out of the breeding herd, and I think that shows up somewhat in what's higher pigs per litter that we're seeing out of the report as well.
How much does that, I know we talk about risk management a lot in terms of cattle. I'm assuming that's a really different conversation on the hog side of things. How much are we bracing for what is yet to come in terms of profitability or lack thereof in the hog and pork sector?
Yeah. So I don't want to say we shouldn't be doing risk management on the hog side, but it's a lot easier to talk risk management at record prices like we have on the cattle side instead of what's lower prices on the hog side. I guess here is hey, if we get some rally in prices, hog prices, maybe those are the opportunities to at least begin to lock in some sales in 2024. I think the opportunities aren't as widespread as they are for cattle. I often talk about LRP for cattle these days. I tell hog producers LRP is something for them to pay attention to as well. But using those risk management tools is certainly important. I keep hoping that lower feed costs begin to help the pork industry. We'll see if that unfolds with lower feed costs as we move ahead.
Let's talk demand. I think that comes into play as well. Restaurant performance for this month. We get to talk a little bit on that consumer side of things in our focus this week. Talk to me a little bit about the numbers and how that's kind of showing up in terms of demand on that side.
Yeah, so a lot of so number one, a lot of interesting numbers out of this restaurant performance index. Top level here for a second. For September, it came down 0.2% from August. The actual level for September, 100.4, and this index is constructed in a way that 100 or greater suggests expansion. So we are seeing a number that still says expansion, which is 4 months in a row that we've been 100 or above. Most of those have been just a little above 100. Now you can drill into the current situation. So what do restaurant owners, operators say about the current situation index? And here's where I'll say it's a little bit of brighter light, perhaps. After an August report that showed customer traffic at 97.6, this month turned around for that same customer traffic to be 99. So we're moving in the right direction. The overall current situation index, 100.8. When you look at the expectations, so what do I expect in front of as a restaurant operator? It fell 1.5 points to right at 100 for September. And when you look at business conditions, one piece of that expectations index, it's now been running below 100 for the last 5 months of data that I have here in front of me, and came in at 95.9. Which tells you those operators have some concerns about where things are going to be 6 months down the road.
I think that combined with the jobs report maybe has us a little cautious looking ahead. And I would assume too, like one not meeting expectations jobs report doesn't mean everything is falling apart.
Yes. So a lot going on in the jobs report today. So number one, I always say, let's not forget that we've had the auto strike going on. I think that's affected some of the numbers here a little bit. We added 150,000 jobs in October, according to BLS today. That was below the expectation of 170,000 by economists polled before the report. And I think that same group would have said 180,000 jobs if not for the auto strike going on. So that gives you a little bit of flavor of some of the things we have going on. Unemployment rate, 3.9%. So it was up this month. I also think that's a little bit associated with the auto strike. I'll say this cuts both ways, right? So I don't know where stock market ended the day, but I assume Yeah, so up 257 points, 0.76%. So less chance of the Fed raising interest rates when we see lower job growth. So it's interesting how this jobs report cuts both ways for us. Again, we'll continue to see this back and forth, I think, for a while in terms of whether we see the Fed come along at some point and raise interest rates. But this very particular piece of data today probably suggests it's easier for them to hold the line going forward.
I think it's really interesting how we look at a jobs report, maybe opposed to how other economists might look at a jobs report, because as you're analyzing data or you're looking at the data, we need jobs. We need a higher wage rate to support higher beef prices, demand for protein items that some may consider a luxury or a privilege to be able to purchase. That matters, and especially matters when we're looking at a hog market right now that is struggling.
Yeah, yes. So two pieces here I think that's important for us to talk about. Number one, we do want people to have more money in their pockets, so more total income. We also want them to feel like they have more money available to spend on food. So as interest rates crowd out, as higher fuel prices crowd out, that balance is important. And there's still a lot of uncertainty about what 2024 holds. You know, we got GDP numbers out earlier this week for third quarter where we exceeded expectations in terms of the GDP numbers we saw for the third quarter, which this idea of are we headed to a recession, it's a little hard to be quite as sure we're headed to a recession when we have those strong GDP numbers out. So I keep going a mixed bag, but we do want consumers with more money in their pockets to spend on food, especially pork. Fixing what has been less than stellar demand for pork this year. I keep saying that's the problem. We have producers who financially are in a very difficult situation, not of their own making, i.e. not really supplies growing very much. It has a lot more to do with what's been weaker demand pushing those prices lower. And that's that I should say that's weaker demand relative to what was extremely good demand in 2021 and 2022. Demand this year, not all that different than we would have been pre-COVID. But when you have to feed $5 corn today, some are going to find less than that, I'm sure. That makes it a little harder.
It really is seemed like to get through this, whether we end up in a recession or we don't. Hopefully, obviously we don't, but it's been like traipsing through mud to get through it. And it is going to be well earned if we can make it through this without going into that.
That is well said. And I think there are longer term opportunities for better profitability coming. We just need demand on the pork side to catch up. I really get focused on what can we do with the loin. The loin's the one that's really struggled for me. And when you realize we now spend a larger proportion of our food expenditures on food away from home, I'm not sure that benefits pork as much as some of the other commodities, because you don't find those restaurants with pork chops featured as that's I'm going to this restaurant to have a really good pork chop. I know restaurants that I want to go to have really good steak, and frankly, I know restaurants I want to go to have really good chicken. So I think that demand side and thinking about that food away from home category is important for the hog industry.
Scott, as we look ahead to next week, a couple of biggies in terms of reports, supply and demand, monthly trade data, consumer sentiment. As you take a look at those reports, what are some of the big things you're watching for to come out in that data?
Yeah, I think on the beef side, we continue to talk about high prices. I think that's going to hurt the export side. And the one that you and I are going to have to start watching are beef imports into the United States. I think those are going to continue to move up given how high our prices are. Hopefully we get some continued gain on the pork side. And for me, those are some non-traditional markets that I think we could see some gain in. And of course, WASI, we're still looking for, what's that crop ultimately look like that we put in the bin this fall. And that will be important as we start to get to the end of harvest here.
I really can't wait to see the final numbers for this crop because it has been wild. As I've talked to farmers, so many have said their yields are surprising, that are better than they could have ever expected. And obviously there's some pockets where there's really bad drought and that didn't happen. But in places that didn't receive rain and were hot in the summer are still pulling in yields that make you shake your head a little bit, I guess.
Yeah. So I always say, I think at the end of the day, USDA is not going to win with whatever yield estimates they come out with because of the variability. Some who had tough weather will say their yield's too high. Others that had surprisingly good corn yields saying yields aren't high enough. The other piece of that puzzle I hear is perhaps what we thought were going to be better soybean yields turned out not quite as good as we go around the country, just because of the late dryness and heat that occurred for that soybean crop.
Scott, look forward to seeing you next Friday and to carrying, well, it may, hopefully Friday, it might be Saturday, depending on my travel schedule. So make sure everything aligns correctly.
That sounds good, Megan.
All right, so our weekly livestock market update delivered your email box every Saturday. Go to brownfieldagnews.com. You can also submit questions and comments. And for a rundown of what happens every day in the commodity markets, make sure to check out John Perkins' Market Minute. Have a great weekend. I'm Megan Grebner for Brownfield.